After having highlighted that, considering different subsets of the sample, the average growth rates are mostly similar and there are no significant statistical differences, the next step is to compare the performance of these companies before and after the investment, with the aim to identify any significant differences in the growth rates of the indicators. The data recorded on the EBITDA growth rates of the small and medium-sized enterprises analyzed show trends similar to those of revenues, however with some anomalies. First of all, the investments made in 2013 show a much higher CAGR of post-investment EBITDA, approximately 12%, compared to the pre-investment years. The other periods present data very similar to those found in graph, however the investments made in 2016 show a post-investment CAGR slightly lower than the pre-investment CAGR. Overall, the total average still indicates a higher post-investment CAGR of around 4%, thus confirming the positive impact of the investment despite the excellent growth recorded in the previous 3 years. By observing the graph relating to the net profit, we can observe how the growth rates in the 4 reference periods behave significantly differently from those recorded in the previous graphs. The growth rates are very high compared to revenues and EBITDA, with a post-investment average in 2013 of almost 40 percentage points. In 2014 and 2015, however, post-investment data was much lower than pre-investment data, confirming the fact that in those years, the intervention of a private equity operator did not have a positive impact. Overall, the total average post-investment CAGR is slightly lower, by around 0.40%, compared to the pre-investment average, so the growth rate remains substantially unchanged before and after the investment. We note that the CAGRs relating to the total assets of the target companies are essentially very similar between the pre- and post-investment period. The only significant difference is represented by the investments made in 2015, where the post-investment growth rates exceed those pre-investment by approximately 7 percentage points. Overall, the total averages are high both pre- and post-investment, but in any case, they do not differ significantly from each other. A relevant aspect is also represented by the fact that the investments that took place in the other periods show lower growth rates in the post-investment period, therefore the total average is greatly influenced by the year 2015, without which the average growth rate of total assets would be slightly lower in the 3 years following the investment. Result could be mainly due to some limitations within the sample. One cause, in addition to the small size of the sample comprising observations, could be due to the fact that the database considered does not differentiate the analysis between different sectors. As a private equity investment brings not only a financial contribution but also an endowment of know-how and expertise, the fact that the database contains more than one investment sector could prevent the recognition of a significant difference in performance before and after the investment period. Results, however, show how the two types of companies differ with reference to the average employee's 3 years CAGR. This finding is coherent with the main results provided by an already mentioned EVCA research paper which reveals that private equity and venture capital play a vital role in the conservation and creation of employment at a European level. The research in question highlights that employment grew by an average rate of 5.4% annually over the period between 2000 and 2004. This data is reasonably comparable. In conclusion, we can say that, comparing the averages, the compound annual growth of target firms after the investment is slightly higher than in the previous period.